So now we're going to move deeper into U.S. demand for, or just storage yield for gasoline and refined products in general. So here's where we normally look at that summary of those travel fuels, specifically motor gasoline, jet, distillate, and residual. And when we look at the current demand is at 14.261 million versus last week of 14.193, putting us with the 4-week rolling average of 14.375. So here's where we continue to say that we're just going sideways at this point. Some movements up. We expected, as we said last week, to see this go up a bit. We thought it was going to be driven by gasoline. Instead, it was driven more by jet fuel. And now we expect to see that reverse, where gasoline is going to see this big surge, and then jet fuel will remain fairly flat to down. Now, I just want to draw your eye to 17, 18, 19 in terms of the average. And you can see that typically as we get into Mother's Day, we normally get this big bump that comes into the market on average. You see the movement higher. Then it stays elevated as we go through into Memorial Day. Then people go crazy for Memorial Day. Then it comes back down and it stays kind of flattish as kids finish up school. School finishes, middle of June. And then we see that steady move higher to essentially peak on July 4th. That is the normal seasonal capacity that we've seen over the last, I don't know, 50 years outside of last year. So here's where, again, we just want to keep highlighting that we're just going sideways. And given we're going to get this movement up, but it's just important to talk about how we are just continuing to see this kind of flat line in just general product demand. Now, when we turn to distillate, and we'll kick off with distillate here, you can see that there was still a draw of 1.73 million barrels. And as we were saying last week, the draws were going to continue, the rate of change was going to abate. And that's what you continue to see, that the rate of change is slowing and we're going to start to flatline and then not so much go back up, but essentially go flat in general. We're only 5.1 million barrels off the 5-year average. You still have most of that leveled in pad 3, which again is creating some of those shortfalls. That oversaturation, which is why when we look at the gasoline market and the yield still is as essentially maxed out to create gasoline. So the Colonial pipeline, specifically in pad 3, which is trying to optimize and create as much gasoline as possible, they're going to be stuck because it's not like, again, you flip a switch and you just switch to distillate, resid, other, there's feedstock involved, there's heat, there's chemicals, there's catalysts. Those are the types of issues that remain. Now, when we look at imports, you can see that imports are 90,000 barrels a day over the 5-year, 40,000 a day week over week that are elevated. And you can see it's pad 3, pad 5. Now, pad 5, we're starting to see the delivery of volumes from Asia that's going to remain elevated. And now just when you look at what's happening on refined products, the Colonial pipeline carries more than just gasoline. It carries all refined products. So this means that we will also get an increase in imports because the ARB is opening again for distillate as well, which is going to pull some of this in. And if you think about how that's going to adjust refiners, refiners will, over the next few weeks, look to increase some of their distillate cut as well, just to try to manage some of their gasoline that's going to be in storage and some of the shortfalls that will arise, or I should say arbitrage that will open with distillate. And as you can see, just based on that 29-year average, this is usually kind of that pivot point where we start to go flat and then start to see an acceleration of builds that peak in September. Obviously, as we think about September and what does that mean going forward, well, you have shoulder season into heating demand. When we look at demand, we were expecting to come back to the 5-year average. It just came just slightly below. Obviously, with the shortfalls that we're seeing on trucking, the amount of movements that remain in the system, diesel demand will remain elevated. This is not going away. This is going to continue to be one of those driving factors higher, especially when we think about what is happening on the demand side. This is just something that will bounce higher and come back to the top of that cloud through this week and really well into the next few weeks. We will remain, and this will continue to be a very big push. And then here you can see kind of that drop that normally happens around Memorial Day. We expect to see something similar, but again, you have to get to that point. So we will see that acceleration, over the next few weeks. Here's where we look at just load availabilities through the roof. This is obviously taking market demand index to all-time highs. This isn't going to stop. This is going to remain elevated in general. I've never really seen anything this crazy before. But at the same time, I wasn't around in the 1910s when we had something of similar size on a infection level pandemic. But again, people are driving more, people are doing more things. So regardless, this is going to remain elevated. This will be a source of bids for diesel in general, and this isn't going to stop. But the other side of the equation, when we think about inflation, rates continue to turn higher. And that's also something that will not stop because you have to incentivize truck drivers. They're driving further. They're going to consume more diesel, which is going to, again, drive up pricing because we will have that demand. This is going to continue to be part of that driving force behind that inflation side as well. Now, when we turn to rail traffic, again, the comps are very easy. But when we normalize it a bit, you can still see that grains, forest products still remain elevated. The petroleum and petroleum products, this will benefit because you're going to have to move this product somehow. So when we think about Pad 1 has deals to bring over Bakken crude, Canadian crude as it comes through. That will remain well bid as they come through. Then we will see more activity if trying to get it onto a barge, trying to get it onto rail cars to move it out of Pad 3. That will also accelerate. So we expect to see petroleum and petroleum products get better. Grains will continue to be very strong. Intermodal, again, trying to normalize some of those coastal shortfalls, which we continue to see these massive bottlenecks at the coast. That will keep a bid within the intermodal units as well, which will continue to move through the system. Inherently, rail will see a lot of activity over the next few weeks. Then, speaking of rail activity, this is when we start turning to the port of Los Angeles, and you can see just the week over week, the increase that continues to run through on the import volumes in general. It's unfortunate because we're not able to catch up, and it continues to move through. Our imports remain elevated. They're not going down anytime soon based on this, but they have to get into market, which again is putting that bid beneath trains as well as trucking. Not only trucking to get product into the market, but also to move these TEUs into or containers into the market in general at a rising scale. Here's when we look at temperature in general. You can see it's slightly warmer, but essentially flattish versus the norm. So it just speaks to we're not going to see too much demand we're not going to see any demand really for heating. We're not going to see too much for cooling either. It's just going to be pretty much a stable, just based on when this goes through the end of May. We'll update this each week, but again, we're not seeing too much of a change on the horizon. Now pivoting into gasoline. Gasoline had a build, like we said in the first segment on Colonial, had a build of 380,000 barrels. Then now we're only 2 million below the 5-year average. And as we've been saying, the rate of change was going to be flat. We didn't expect any real change up or down. But the averages have gotten easier because typically this is when we start to see draws accelerate. And because we're getting closer to that average level or, the days of coverage because we're just sitting here flattish as refiners continue to focus on creating gasoline and our imports remain elevated. So then when we turn to blending components, you can see that where blending components had a build of 480,000 barrels, and now it's only 700,000 barrels away from the 5-year average because we continue, the U.S. refiners continue to focus on that aromatics, trying to bring in some of that volume and to try to capture that margin as we go into the the summer driving season. Now, the EPA waivers will eat into some of those blending components because you're not going to get the benefit. You can save it for when you need it versus what's being sold right now. So you can try to sell a cheaper volume of gasoline and try to capture a wider arb. On the import side, even though imports were down 85,000 barrels a day, driven by Pad 1, which was down 112,000 barrels a day, you're still 248,000 above the 5-year average. And just based on what we said in our special segment on Colonial Pipeline, they are accelerating, and they're accelerating quickly. Now, because most of this isn't going into Pad 1A or New York Harbor and Boston, but it's actually going to hit throughout Pad 1, you're actually going to see these levels of imports increase over that time period because it's just going to be spread out. So the pace of imports is going to accelerate. When we look at Pad 5 was up 19,000 barrels a day. And again, this is the Asian product that is starting to show up. And just based on we have about 415,000 tons coming through, that will also accelerate. The timing is going to be difficult just because of, as we talked about in the 2 slides ago, when we look at the port is still remains very crowded, which is going to limit how quickly some of this can offload. But net, we're going to get builds in Pad 3, draws in Pad 1. The pace of that is going to dictate how big these gasoline builds get, how much of it can Pad 3 push off into the coast. Now, we talked about the Jones Act. A way to get around the Jones Act is you can put gasoline on a foreign flagged vessel that or isn't Jones Act compliant. But as long as it pushes off from the same slip, not the same port, it has to be the exact same slip, and then come back into that slip, that is not deemed as an import of a foreign vessel. Now, let's just use an example. If let's just say Valero. So if Valero puts gasoline on a boat in the Houston Channel on slip A, and then it goes into the Gulf of Mexico and then comes back and offloads in slip B, that is a violation. If it comes back into slip A, that is not a violation. So we've started to see refiners putting gasoline onto boats, pushing that into the coast, into the Gulf of Mexico, for 2 reasons. One, save space on storage, but also when the Jones Act is waived for now, they'll be ready to go and move it into the system quickly. So again, this is showing just the adjustments that are being made in anticipation to changes in policy, but also to try to manage their storage. So when we look at just showing the gasoline demand, so when we look at what has happened so far, so gasoline demand was already up last week based on Gas Buddy data. It was still below the high by a small amount, by about 0.5%. But this just shows where, and you can kind of see where we are. I'm sorry, it was above that high that we achieved for Easter and spring break by about 0.4%, and we expected to see that come down because people were driving for Mother's Day. You had people doing stuff, going out and buying gasoline. This spike is just showing the acceleration from people purchasing gasoline because of Colonial Pipeline. So this just kind of shows the amount that has been pulled through in general. So to put it into context, Tuesday, gasoline demand was up 14.3% from the prior Tuesday. Week to date through Tuesday, gasoline demand is up 10.7%. Monday, gasoline demand was up 19.9% from the prior Monday to a level that rivals Friday, the busiest day of the week at pumps. Monday's demand was 18.5% higher than the average of the prior 4 Mondays. So Friday saw a huge surge. Again, people getting gasoline ahead of movements for Mother's Day weekend. And now we're taking that out just because people are panicking. And this is the pull through that we're seeing, which will cause a change in demand as we go through the next 2 weeks, because as people fill up, as people panic, as they feel comfortable with their full tank at home, this will then reverse the other way. So then when we look at pricing, the national average reached $3 a gallon, first time in nearly 7 years. The national average price of gasoline has reached $3 per gallon for the first time since October 30th of 2014. This is just looking as of May 10th. So clearly we're in May 12th and the Colonial pipeline has shifted things a bit. So this has actually gone higher. The week change is up 7 cents when we look at May 3rd to May 10th. On the gasoline side, that is obviously going to go higher. We're already getting ready to that. And just to look at gasoline pricing in general, now that we're over $3 ahead of Memorial Day kicks off driving season. We're not going to see, we're not going to see that reverse. So instead, we're going to stay elevated, which in general is going to continue to put some of that pressure as to when do we see some of these adjustments in gasoline pricing. So then when we look at diesel and shifting over a bit, so diesel prices were up 4 cents. They're at almost $3.19 for May 10th because of the shortfalls. Now, again, Colonial Pipeline moves things outside of just gasoline. It also moves diesel. This is going to create some of those issues as well. You're going to see some of this driving higher again, which will put more pressure. So all of these going up, it's going to increase the cost of shipping. It's going to increase the cost of moving around as a consumer. Again, these are some of those negatives. Then when we look at blending components, you can see that typically we start to get some drawdowns. Instead, we've just gone up. Rate of change has been flat to slightly up. That's going to continue in general, which will be some of that overhang when you think of margin for the refiner. So then when we shift over a bit and we start looking at total gasoline demand, sorry, just trying to keep my throat from getting scratchy and coughing in your ear. So when we start to look at gasoline demand, you can see that we're starting to come down against the seasonal norm. So we're getting a counter-seasonal decline in gasoline demand in general as typically this is the pivot point over the last 15 years when it starts to go higher, peaking at that period of Memorial Day and then starting to slow down. Instead, we're just, again, seeing this steady state of really not much movement because, again, people are, even though they're moving about a bit more, it's still not back to what was normal. Now we always like to look at the last 5 years. So when we turn over to the next, 19, 18, 17, 16, to look at gas demand, we were expecting to see a little bit of a move up, not a higher high or anything, but just, a positive move. Instead, we made a lower low based on the last month or so. And you can see that that's really going to counter to trend. Now, we think that because of what Gas Buddy has shown us, what is happening in the market in general, this is going to shift up. We will make a higher high, but again, that's that pull through of demand. So we will get closer to, we could probably get as high as 9.3 million just based on the calculation, but then we'd see a big drop down after that. So this is just going to be a very noisy number, if you will, as we go through the next few weeks. Now, when we look at propane had that big build of 2.54 million. This is usually when we start to see those builds. So there's nothing too crazy when we're looking at some of these movements. We're still 8.9 million below the 5-year average, starting to catch up, but still, if you look at Pad 3 is still 7 million barrels below the 5-year average. So it's just right now, we're very close to that 2017 rate of change. And we think it'll continue to accelerate. So we should, the hope is that we're going to get back to the 5-year average based on July. I just think that we're going to continue to see a fairly robust export market, and not only just an export market, just the demand for plastics will keep things fairly active. So this is just looking at U.S. activity. The thing that I always like to look at is, obviously the cases continue to trend lower, the movement in the right direction. New COVID deaths continue to trend lower. Lockdown index has gotten better. We're now closer to 50. As things continue to reopen, the biggest problem that we continue to see is this stickiness in terms of, consumers are moving about more, but again, it's not huge travel, it's not long travel. And now with the issues that have come about with the Colonial, that's going to be another headwind. The biggest problem that we continue to see in general, it remains on the job side, and we'll talk about that in very deep detail in the economy show. But that between the rising prices and the inflation in general, and those jobs numbers, unemployment numbers, those are some of those headwinds that are going to remain, which will essentially cap some of that real, that real reopening demand that I think everybody's expecting. And this is why we like to look at the data and kind of what is the data telling us in general, and what does that mean for the next few weeks, which it continues to be fairly lackluster. And then when we look at other places that have been reopened, other places that have that should have seen some normalcy, we're just not seeing a lot of that activity. Now, when we look to the numbers in Google, looking at the mobility charts, you can see that parks remain elevated. People will still do more, but again, it's going to be weekend versus weekday. As the weekend continues to be parks, local, seeing family that may be around you. We're seeing some acceleration in terms of residential. So residential starting to come down. Transit stations are coming back up, but workplaces are fairly flat. So what does that tell me? That tells me that work from home, because you can see the dips. There's less people working from home. We have a chart on that in the economy show, where the work from home people have declined over the last 6 weeks, but they're going more to the transit station. Again, not a lot. You can still see it very low, but it's still moving in that direction, and that's something that we think is going to see some pace, some increases over time. Now, when we look at mobility trends, you can see that the U.S. has been fairly in a fairly flattish pattern over the last week or so. This is one that we think is going to roll down a bit. Again, still stay positive, but still move a bit lower. The benefit that we're seeing right now, Italy, Germany, UK, is starting to get a little bit better. It's starting to get closer to baseline, which again is just pointing to a bit more gasoline consumption within that region. So then when we look at vaccines administered, the U.S. had a slowdown, as we talked about last week, as people who want vaccines can already get it. Now, you don't even need an appointment, or the appointments are, I should say, you still need an appointment. They're just not hard to get. There are drive-up sections that are areas that are opening up. And when we look at the pace at 0.66, that's consistent with last week. We haven't seen much change. France has slowed down, which is something to watch. Germany has accelerated a bit, still not at the rate that we'd like to see. AstraZeneca is getting pulled from some European nations' arsenal, and that's going to cause some of those adjustments. But the one that we are going to want to see right now is really India and Brazil, because those are the two areas that continue to have some big headwinds ahead. When we look at COVID, we're hoping to see that accelerate and, again, try to get back some of that normalcy. Now, as we were saying here in jet fuel, so jet built by 1.68 million. It's still below the 5-year average by 1.5 million, but above the year-over-year by 100,000. You have to think about kerosene can be some of it can be created into octane and go into the gasoline pool, and some of it can also, and all of it can be pushed into the distillate pool. As some of the jet fuel has been recovered or separated, that has helped draw down some of that distillate. Here you can see is that we had that bounce higher in jet fuel demand. This is where we think that we're going to stay within this fairly tight range and just go back and forth, as we were saying, kind of that 1.3, 1.4 is the high, and then back to that, let's call it that 1.2 or so. 1.1 is going to be where we kind of live. Now, the issues are going to come up because, again, Colonial moves other things. It also removes jet fuel, and that's going to keep this essentially fairly flat. Now, the reason why we look at that, we look at the global departures. So when we look around the world, you can see it's up a bit, and it's just because we're starting to see a shift. So North America is starting to see a recovery of flights, and that's because Canada's coming back from lockdown. You're starting to see some of that acceleration. You're starting to get some of that pull through for the summer travel. But when we look at Asia Pacific, that is rolling over, but Europe is getting a bit better. So net, Asia Pacific is some of those headwinds. So the average number of departures increased by 200 week on week. India, Japan, and Vietnam led the declines, with the U.S. leading the growth in general. So when we think about this globally, the passenger flight schedule for 12 weeks ahead declined by just over 3.5% versus the last week. So even going out the next 12 weeks, we're seeing a decline, and it's really being driven based on Asia Pacific and this rest of the world, as North America, I think, kind of gets this rally and then goes sideways as they essentially reassess what's happening in general. So there are on average 2,400 fewer departures scheduled to take off each day over the coming 4 weeks compared to last week, a smaller cut than in previous weeks. So these are some of those, again, these restrictions that we're seeing, and it's really being driven based on Asia Pacific and that rest of world, as Europe kind of flatlines around here and the U.S. maintains some of this elevation. So this is looking at TSA passengers. You had some of that bump as everybody went to go see their moms for Mother's Day. Now we've come back down. This is just looking at the average. So the average is that pink line. So you can see that, we're getting higher highs, and then we're coming back down to those lows. The other reason why I left this in is because you can see the pivot higher here. So you can see that typically we start to see an acceleration. You can see that in the yellow, you can see that in the pink, that the rate of change starts to pick up because, again, you have Memorial Day, you have summer. So we will see passengers increase along that normal. It's just we're not, based on what we're seeing right now, we're not going to close the gap and get to those 2019 levels. It'll be interesting to see if we can get past this average number and start to track somewhere between the average, which is taking 2019 versus 2020, or if we're going to stay within this pink line. I'm assuming right now, based on what we're seeing, that the lows will be the top of the average, and we're going to continue to make some higher highs over the next few weeks, but still not based on some of the expectations in the market in general. So this is just looking at open table. You can see, just based on what we're seeing, it's going to remain fairly flat. Just based on the coming few weeks. And when we look at open table, the regional breakdown, as we've been saying in general, that we expect to see things staying between 25 and 30% on a global level. You can see some movements in Canada, in Germany, in Ireland. You're starting to get some of that positivity. UK, US, you're starting to see some of this reopening. We don't think we're going to get back to normal, but at least we're getting to this fairly comfortable level where we're starting to see some of this, some of these elevated levels that should continue to come through, especially as things get warmer, not just in the U.S. but also in Europe, which will enable a bit more activity, as you can see in Germany. And then as Canada reopens, that's obviously going to be a net positive for the activity on the restaurant side in particular.